Bank of Canada just raised interest rates 75 bips, 0.75%. I am in shock. What about you, Justin?
Utter shock.
Utter shock. No, not really. We were expecting this. And so is everybody else. There's a 20% chance it'd be 100, maybe it's going to be 50, but most likely it was 75. And so what does this mean for buyers today? We're going to get into that. And we're going to talk to you at the end of this video about what it means to be a purchaser looking for a home right now and planning on using a variable mortgage, and your rate just went up 75 bips. We're going to walk through that number by number, how that affects your affordability and your payments. And so if you get any value from our videos, please like, subscribe, comment, and share with a friend or your family.
So the immediate impact on this rate hike is that buyers now have to purchase with 4.95% variable rate instead of 4.2%. This means actually qualifying at a 6.95% stress test instead of 6.2. So that really reduces your buying power from a mortgage perspective of 7.4%. This really only affects people with variable mortgage if you have a fixed mortgage.
Forward looking, so.
Yeah, exactly. So those rates aren't going to jump up. They're already pricing in these jumps. As we said, we expected this. So did the banks.
So we've had an uptick in activity over the last few months, which if you've been following us, you've heard us talk about that. More showings, more calls, more sales. Not reported yet in the stats, but we'll see those in September for the last part of August here. And the question is, were these buyers rushing to purchase before the September rate hike and trying to lock in a variable mortgage? Because remember, there's two types of variable mortgage. There's those that the payment moves up with interest rates when interest rates go up or down. And there's also those where the payment stays static. And so even though interest rates go up, more of that payment just shifts to interest. So people could buy on a 4.2%, lock in this variable rate, and then they're qualifying for less on the stress test, and their payment is about 7 to 9% less. And so buyers, if they're aware, they would be rushing to buy in August before the September rate hikes. And prices are already down 25% on detached houses, 15 to 20% on townhouse, 5 to 10% on condo. So there's some decent price declines there. And so the question is, what are we going to see happen in September? Are buyers aware? Were they expecting this rate hike? And did they kind of price it in their mind and be like, okay, we know this is coming and we're still going to be actively looking in September? Or were they shocked by it? My perspective is that I think buyers are a lot more aware of these rate hikes now than they were earlier this year. Even if you look at some of the larger YouTube accounts that cover Canadian real estate, they were getting 5,000, 10,000 views on their rate hike videos earlier this spring. Now they're getting 60, 70,000 views on these. People are aware of it. They're following it. And I think a lot of buyers are too. And mortgage agents are keeping their buyers informed.
So interestingly enough, this is actually only the second rate hike that affects how much people can qualify for on the stress test. This is because you either qualify based on a 5.25% interest or your variable rate plus 2%. So prior to July 12th, variable borrowers could actually still get the same size mortgage they could have gotten in 2021. So you've probably seen in the news that thousands and thousands of mortgages are going to hit their trigger rate today. Let's break down, see if it's actually going to affect things. For example, if you had a $1 million mortgage at 4.95%, your interest payments were just over $4,100. Now, if you had a $1 million mortgage at 1.8%, your total payments are just over $4,100. Therefore, their trigger rate is actually at that point. If you had a 1.8% mortgage, your trigger rate is 4.95%.
And that's because your entire payment now is interest.
Yes.
And so if the rates go up any more past that point, you actually owe more interest every month than your static mortgage is. And so the banks usually don't like that. No. But Justin's going to tell us a little bit more about how different banks are treating this. Every bank is different.
Yeah. So, RBC, for example, said they're only going to increase your payments by $2. At first glance, that doesn't really make much sense. So what they'll do instead of charging you more each month, they'll simply just add it to your mortgage balance. So your loan value will now increase.
If you've paid down $50,000 of your mortgage, let's say an $800,000 mortgage, you got a $70,000 mortgage, you still got $50,000 of room where RBC will now keep your payment the same, even though you owe more interest every month than your mortgage payment is. And then all that interest will just accumulate on your mortgage balance. Yeah. And so there's $50,000 in room where they will be accumulating that interest on top of there. Now, what happens is if we reach a trigger point. Is it trigger point?
Yep.
Yeah. Trigger rate, trigger point. There's trigger rate, which is the rate at which your interest surpasses your payment. And the trigger point, your mortgage balance actually reaches balance you originally loaned from the bank. So let's say you hit $800,000. At that point, the bank makes more changes. And Justin, why don't you touch on that?
Yeah, they give you 3 different options, essentially. They either say you can give us a lump sum to pay down more of your mortgage, you can increase your payments to cover all of the interest, you're past that trigger rate, or you can simply just convert to a fixed rate.
So is this going to crash the market? We see in the news, we see people on Twitter, trigger points, trigger rates. Oh my gosh, people are going to be owing another 40% of their mortgage in September. You know, from what we've seen from RBC mortgage holders, definitely not. The other banks, you know, I haven't seen anything catastrophic coming down the pipe. I think where this could get ugly, if these rates stay high for 2-3 years, what you're going to have is people with mortgages that they took out in 2019, 2020, and they're going to be coming up for renewal in like 2024, 2025. And if rates are still at 5%, their payment, because when you get to your renewal term, if you've been keeping this small payment and your interest charges were massive, even more than you owed every month because the bank let you do this, what happens is at that renewal date, your mortgage amortization has to reset. And now if you took out a 30-year amortization, now it's 25 years, but you have to reset down to a 25-year amortization. You have to amortize all that interest that you accumulated again, and you have to do it all at this new high 5% rate. And so that is going to boost mortgage payments 30% plus at your renewal date, and that could be extremely hard on people. It could be extremely hard on our economy. It could cause some distress selling, increase inventory, things like that. So that's more what I'm worried about, which is years down the road. And rates would actually have to stay high for that to happen. So far, what we're seeing with the trigger rates, I don't think it's going to be a huge deal, but we'll see. It totally depends how the banks handle it. Lots of people asking, should I go fixed? Should I go variable? Now, really how I look at this is it comes down to your personal risk tolerance and your view of the future. If you believe that rates are going to stay high and stay elevated, if you think that inflation is going to be persistent for the next 5 years and the Bank of Canada is going to have to counter inflation with high rates, Stanley Druckenmiller came out and he said that never in history has the central bank killed inflation without raising their central bank rate above the rate of inflation, which in the US is like 9% right now. In Canada, I think we're at 7 or 8%. We just raised to 3.25%. We're still like 5% below the rate of inflation. Imagine the central bank rate going to like 7 or 8%. Mortgage rates would be like 9%. Armageddon. So obviously our debt levels are extremely elevated right now. We're extremely sensitive to interest rates. So maybe this isn't like other points in history and we don't have to actually raise that rate above. Now, not only maybe, this is what everybody's banking on. If we actually have to raise the rate of interest above the rate of inflation, we're toast. Like it's over, it's game over. So probably not. But still, do we have to bring interest rates up to 4%? 5% even, which is higher than they're predicting right now. Would we have to hold them there for the next 4 or 5 years? If that's your view, then you should probably take a fixed rate. And even if you're extremely worried about, which I would say is fair, if you're worried about maybe rates, right now we kind of got this 5-year fixed at 5.2, terminal variable rate of maybe like 5.5, 5.6. If you think that central bank maybe is going to raise rates to 5%, which would land variable more at like near 7%, well, fixed is going to be up in the 6s as well then, because that's more than they're currently projecting. If you have that view, you should probably go very fixed. Now, if you are more of the view that the central bank's going to raise rates here and very soon our economy is going to get hurt and they're going to have to start cutting maybe next year or the year after, and you think that, maybe variable rates come down into maybe the 4% or the 3%, average over the next 5 years, you probably shouldn't go with a fixed. And remember, you can also fix your rate for the next 1 year, 2 year, 3 or 4. It doesn't have to be 5 years. So you could fix your rate for the next 1 year and be like, hey, I want to see how this plays out. This is probably what I would personally do. I'd be like, I want to see how this plays out over the next 12 months. Let's see if they get a handle on inflation. We should have a much better idea by mid next year. And then, and then it resets in 12 months. Now, that might still be too risky for you because at 12 months, well, if inflation's at 7%, you're going to be absolutely sewered. So it totally depends on your risk tolerance, totally depends on your view of the future. But personally, I think that they're probably going to start rate cuts in a couple of years. And over a 5-year term, I would expect my average interest cost on a variable to be less than 5.2%, which is the current fixed rate. Yeah. And so one other thing that's interesting is if you look at last month, they were actually pricing in rate cuts for starting next year. Now, if you look at it, by July, they're projecting 3.75 to 4% terminal central bank interest rate, which is the same as it is in December. So the rate cuts they're pricing in are kind of gone now. And that's because the central banks have been coming out and been saying like, hey, look, we're dealing with inflation. It's persistent. We're going to keep dealing with it and we're going to keep going hard on it.
So check out this quote we just put up on the screen. The Bank of Canada released this as they did the rate hike this morning. Clearly shows they have one intention, and that is to stop inflation, and they're persistent at that. The Bank of Canada is very clearly committed to doing more rate increases. The market is already pricing in another 0.5 to 0.7 rate hikes this year. But the real question is, are they going to go past that? People say they might stop at that 0.5 or 0.75.
Yeah, and that's what the markets are pricing in.
Yeah.
Markets are pricing in. Economists are saying, okay, the Bank of Canada is going to do another 0.5, another 0.75, and the Fed, and they're going to stop there. But when you read this quote, does this sound like a central bank that's done hiking rates in October next month?
They've warned us before,
I don't know.
And they shocked us with the 1%. So
this isn't like we've got predictions here. By the end of the day, they could carry this thing further if inflation is not getting under control. They will take this further. So. We'll see what happens. So we've got two more rate hikes, October 26th and December 7th. December 7th is kind of the one that's up in the air. Are they going to hike, or is October going to be the last one? And we'll see. Something interesting to note is that because Canada is being so aggressive with their interest rate hike policy, we're actually ahead of the US. Because of that, our dollar is staying quite strong, actually. So if you compare us to Australia, which just hiked 50 bips yesterday, weak. Yeah. They brought it up to 2.35. We're at 3.25. We're 0.9 ahead of them. And so what's interesting is that the Australian dollar against the US dollar is down 7% this year. Canada's only down 3%. Yeah. And what that means is that when you have a higher interest rate, international investors, and institutions, they will move their money into that country's currency and invest for a yield in that country, in their bonds and certain mechanisms, because they're offering a higher yield. So why would you go put your money in Australia to get 2.35% when you can go to Canada and get 3.25%? So what that does is, as investors and institutions move their money into a country's currency, it increases the demand for that currency. And what do we know about increased demand? The price goes up. And so that's why there's less money flowing into the Australian currency and more money flowing into the Canadian currency to get this yield. And so our dollar is staying strong compared to the US. And that is why people say we need to follow the Fed's rate hikes, because we don't want our dollar to tank. We don't want money to leave us and go to the US instead, because they're offering a higher yield. So just an interesting side note there.
So let's walk through the different ways this is actually going to affect a purchaser today. We kind of narrowed it down to two different ways. The first way is their payment goes up. So let's say you have an $800,000 purchase with 20% down. At 4.2%, their payment would have been just over $3,100 a month. Now that's actually $3,400 a month. That's a 9.1% increase. That's not great for the monthly budget. I don't know how many people love just all of a sudden spending $300 more a month.
Nice little September surprise.
Yep. And, if a buyer had just bought last month, they actually could have kept this $3,100 payment even when the rates go up. They just shift a little bit more to interest rather than principal.
Yeah, so that's a 9% increase in your payments for the same priced home if you had closed on a mortgage yesterday versus today. So when you think about that, it's like, okay, well, we're buyers rushing to purchase in August, knowing that their payments will go up 9% on September 1st. And our prices, how long is it going to take prices to fall 9% to compensate for that? At the beginning of this whole rate hike cycle, we saw prices drop drastically. Detached prices dropped like 20% in 3 months. That's not happening anymore. They've plateaued. We're still seeing some softness in the townhouse and the condo segment. You kind of have this blow off top, and then the declines really start to slow. So how long is it going to take for prices to go down another 9% to compensate for this increased payment?
Yeah.
I don't know. Maybe it would happen this winter. Maybe it would take even till later next year. Maybe not if they reverse rates, right? So there's this huge question mark, but everybody knows that this kind of blow off top's done. The rate of price declines is slowing drastically, at least in the detached segment. Maybe these August buyers were smart to buy and keep this lower payment, especially if we get another 50 or 75 bips in October. Then the payment's going to be like 15% higher than it would have been in August. And our price is going to be down 15% by October. Probably not on base what we're seeing. The activities, it's here. So really interesting things to think about. Maybe this is why we saw this bump in activity in August. Will it continue for September? I don't know. There's a seasonality factor there. We're watching it really closely, and we'll keep you guys updated. So the other thing to talk about is a stress test. So like we said, the previous 100 bips hike was the first one to actually affect variable rate borrowers on the stress test. This is the second one. So previously at 4.2%, a buyer needed $180K to afford a $800,000 home with a 20% down payment. Now they need $193,000 to afford that same $800,000 home. So that's only an extra $13,000 a year, but I don't know if you, with like a week's notice, can just go and find an extra $13,000 income. I mean, that'd be great if you could, but not everybody can do that. So you need an extra $13,000 a year to afford the same home. Or if your income stays the same, which of course most people's does, $180,000 a year will only get you $740,000. So that stress test actually took you from $800,000 down to $740,000. And we've got active buyers who are literally looking at using a variable rate, and they're like, hey, I can only buy 7% less now than I could last month. That is a real thing. So it's going to be really interesting to see how that plays out in the market. And if the pricing adjusts, or if supply demand dynamics are too tight now and there are enough buyers out there that prices just hold for the next couple of months, it's going to be really interesting to watch. And so thank you so much, guys, for watching today. And we hope this was super informative. Please like, subscribe, comment, and we're looking forward to the next video.